Welcome to the latest episode of Quest for Twice. The market has been volatile in the last several weeks, so this is a good time for me to review my portfolio performance and discuss risk management. So as of March the 8th, my portfolio overall has the same performance as the S&P 500. However, if I focus on my growth portfolio, which is about 27% of my total portfolio, the performance year to date is a decline by 28%. And that's worse than the benchmark Morningstar Small Growth sector. The underperformance of this sector is offset by the outperformance of my energy sector holdings, including Energy Transfer and Kinder Morgan. Combined, they are 18.5% of my total portfolio, and their return this year is positive. Considering that I drastically outperformed the market last year, so I consider the performance so far is satisfactory. This is essentially a stress test on my portfolio. And so far, I think that my portfolio is holding up. Given the increased risk and volatility in the market, this is a good time to specify my risk management approach. Given that I'm a buy and hold investor, stop loss is not an applicable tool to manage my risk in individual stocks. So my risk management approach is to diversify and right size each investment. How do I right size each investment? I developed a score to size my investment, and I'm going to go over that. So I use Morningstar.com to help me develop my allocation score. For example, for Equifax, at the current price of $224 per share, it's 34% discount to its fair market value according to Morningstar, and it has a wide moat. Through my own research, I have a high conviction in Equifax. As a result, the multiplier I use is 100%, i.e. there is no deduction to the discount factor. So 34% discount multiplied by 100%, I get an allocation score of 34%. Similarly, for Mercado Libre, at current price, its discount to fair market value is 39%, and the multiplier is also 100%, so the allocation score is 39%. On the other hand, Upstart has a discount by about 58%, so it's a larger discount, but its moat is narrow and my conviction is only medium. So the multiplier is 50%. 58% discount multiplied by 50%, I get a 29% allocation score. For InMode, I believe it has a narrow moat and I have a medium conviction, so the multiplier is 50%. And for Amazon.com, the discount is 33% with a wide moat, and I have a high conviction. Not as high as Equifax or Mercado Libre, so the multiplier is 75%, so the allocation score is 24%. For JFrog, it's a narrow moat with a low conviction, so the multiplier becomes 25%, and the allocation score is 11%. And for Salesforce.com, I also have a low conviction despite the wide moat, because I haven't done any research about this company. So the multiplier is 25% and the allocation score is 9%. Once I derive the allocation scores, then the amount of money I put in each stock is proportional to its allocation score. The higher the score, the more money I put into it. There are two aspects to the allocation score I like. The first one is that if a stock is suffering more sell-off, then that will increase the discount to its fair market value. And then it will automatically increase its allocation score, and I like to buy when a stock is pulling back. The second aspect is that if I increase my conviction through deep dives, then I will also be able to increase the multiplier and increase the allocation score as a result. The flip side is that for some companies, even without the deep research, I can still buy some and just keep the conviction low and the multiplier low so that I won't allocate too much money. So I'm going to go through some examples here. So one is Twilio. It has a large discount to fair market value according to Morningstar.com, but my conviction is low, so the allocation score is 15%. Similarly, DocuSign, I have a low conviction and a low multiplier. Also for Boston Beer, although I did the deep dive, my conviction is still low, so the multiplier is also low. The same applies to Google, Microsoft, and Facebook. Those are very good companies with a wide moat. But just because I haven't done much research, my conviction is low. Their allocation scores are relatively low. Still, even without the research, I can still allocate some money to these companies. The last one is Poshmark. Through my research, I have even a lower conviction compared to some of the other companies. So the multiplier is 10% compared to 25% for those low conviction stocks. As a result, the allocation score is also even lower. So this summarizes my risk management approach for my growth portfolio. A good aspect of this approach is that it takes away some of the emotional aspects of investing. The more market sell off, the larger discounts they will have, and then the allocation scores will go up if everything else is equal. Until next time, happy investing.